a crisis in collateral. This is terribly important because virtually every financial deal involving derivatives and leverage and all the rest of it, you require to post collateral, and that collateral can be cash. Very often it can be bonds. People go to the dollar, and that's exactly what we're seeing at the moment. I mean, people are buying the dollar because everywhere else looks really pretty awful. Surprising is that you would have thought that the yields on US Treasuries would have softened in the wake of that. But no, they soared.
Gold's ascent amidst geopolitical turbulence. As the world grapples with a series of unprecedented events, including geopolitical tensions, monetary policy decisions, and economic uncertainties, gold's allure as a safe haven asset is unmistakable. In today's episode, we'll talk about the commodity markets, and we'll discuss the geopolitical tensions and gold's safe haven. The recent escalation of conflict between Israel and Hamas has rekindled the age-old belief in gold as a sanctuary in troubled times. Investors, concerned about the instability in the Middle East, are flocking to gold as a store of value, pushing its prices upwards. This move is not just a reaction to a specific geopolitical event, it's a testament to gold's enduring role as a safe haven asset. The global reach of gold. As global investors turn to gold for safety, the precious metal's value is soaring against various currencies. While gold is on the verge of hitting $2,000 an ounce in US dollars, it has already reached all-time highs in several currencies worldwide. Notably, it recently rallied to $3,159 in the Australian dollar, underscoring its global appeal. Australia, the world's third-largest gold producer, is witnessing a resurgence in its gold mining sector thanks to the precious metals performance. Gold production in the country surged by 11% in the third quarter, reflecting an increase of 8 tons from the previous quarter. Better weather conditions during Australia's winter months enabled gold producers to process higher-grade ore. As a result, the sector is now valued at approximately $30 billion. Now we'll show you a collection of clips of. First, like, subscribe, and turn on the notifications bell. And check our pinned comment for some massive sign-up bonuses.
If you look at it this way, the rise in yields on the US Treasury since around about 2020, when it bottomed out, has basically undermined the value of a 10-year Treasury by something like 30%. So, what does this mean? It means that the collateral value has gone down, so you've got to go and top it up. And so what do you do? How do you top it up? Well, the answer basically is you've got to liquidate something in order to put more cash in as collateral. And this is what is now driving bond yields in the US. And it's also undermining bond yields elsewhere, where there is the same problem. I mean, the Eurozone, for example, if you look at the chart for the German 10-year Bund, which you'll be very familiar with, I mean, that again is soaring into new high ground, admittedly at a lower level than US Treasuries, but then hasn't it always been at a lower level than US Treasuries? And look at what's going on in the yen. I mean, it's just staggering, the incompetence of the Bank of Japan. I mean, they came out, I read some sort of statement from the Bank of Japan that they were holding on to 0.5% negative rates in the fight against inflation. What? I mean, I couldn't believe it. I read, perhaps I misread it completely, but that seems to be their overall approach. They seem to think that minus 0.5% interest rates, is sufficient to fight inflation. And they are fighting a losing battle. I mean, at this moment, if I look at the Forex rate for the yen, it's just about to break through. It's standing at 149.912, just about to break through into new high ground above 150 to the dollar. Of course, a high number is a weak yen, so it's slightly confusing in that way. So you've got to look at it upside down. And the result is that much excitement in the gold bug world, because they say, look at the soaring price of gold in yen. Yeah, sure. I think the Japanese haven't missed that one either. So these are the things that's going on, and I think I think the point about collateral is actually very, very important, because we had an example of this in the UK when Liz Truss was Prime Minister, very briefly, 44 days. She and her Chancellor produced a budget which ended up with her having to leave. But what it did was it created a crisis in the pension funds. Now, unbeknown to us all, the pension funds we're trying to respond to zero or close to zero interest rates and very low bond yield rates by leveraging up their bond investments, their portfolio investments, with a sort of, if you like, I can't remember what it's called now, but it was a leverage which required them to post collateral when the bond values started falling. And what happened? We had an absolute panic. I mean, bond prices absolutely collapsed on this until the Bank of England stepped in and bought £68 billion worth of gilts and supported the market. And at that point, the panic subsided. So something like that has probably got to be done by the Fed, but I think the Fed at the moment is still keeping...
Highlights the Federal Reserve's influence as gold's ascent is occurring in a context influenced by various economic and monetary factors. The Federal Reserve's commitment to maintaining higher interest rates is one of them. The central bank's stance is to keep interest rates in restrictive territory for the foreseeable future, aiming to bring inflation down to 2%. This commitment has played a role in driving long-term bond yields to fresh 16-year highs, with 10-year notes reaching 5% this week. Interestingly, some economists and market analysts have noted that growing concerns over U.S. government debt are also driving bond yields higher. Andrew Maguire questions, what will happen if the Federal Reserve loses control over the long end of the yield curve? They may need to step in and purchase bonds, a move that would have positive implications for gold. The U.S. national debt, which currently stands at $33 trillion, is a significant factor affecting the bond market. While the exact point at which higher yields will attract buyers is uncertain, it is clear that the monumental scale of this debt is a compelling reason why some investors might hesitate to hold significant amounts of U.S. Treasuries. Gold's path to potential all-time highs. As gold nears the $2,000 an ounce mark in U.S. dollars and all-time highs in several other currencies, experts believe that gold's resurgence is not just impressive, but also indicative of the market's response to prevailing negative sentiment. Philip Strebel, chief market strategist at Blue Line Futures, observes, gold was so undervalued, and now we are seeing some froth in the market because investors are all chasing themselves to own it. Moreover, the precious metals track record in times of crisis has not gone unnoticed. David Morrison, senior market analyst at Trade Nation, remarks, gold is doing exactly what it is supposed to be doing in times of crisis. He believes that gold has already breached key resistance levels, and there is potential for it to reach new all-time highs. Now we'll show you the best clips of the latest interview where he discusses his gold and silver outlook for 2024 and has a message for all precious metal enthusiasts. Remember to subscribe to the channel so we can reach 1,000 subscribers. Let's get into the video.
For a long time, I've been saying that we're facing a credit crunch because of contracting bank credit, and that's sort of happened. And the other thing that goes along with it is that as you get contracting credit, what it tends to do is spark demand for credit, because contracting credit basically means that the banks are frightened of extending their obligations and they want to withdraw their obligations. And inevitably this comes at a time when sales might be slowing down for the average company. Their input costs are rising, and so they need more cash, if you like, to bridge the gap. So they go to the banks and say, please lend us some more money. And the banks say, no, Well, they say, well, we'll lend you half of what you ask for, but it's going to be at a higher rate. And so this is actually what happens. I mean, people just don't seem to realize that when the banks actually start withdrawing credit from the economy, interest rates rise. People associate a slowdown in money supply with, they think, oh, it's recession, which means that interest rates are going to fall. No, not at all. It doesn't work like that. I mean, eventually it might work like that, but certainly not to begin with. So that's what we've seen, Kai. We've seen things slow down. A lot of risk is emerging in markets. A lot of risk is emerging in credit, and therefore the lending by the banks. So, that's continuing. And I think particularly in the last 3 months, Russia and Saudi Arabia have tightened the screws on us by cutting off oil supplies by a further 1.3 million barrels a day. And that's had the effect already of driving up oil prices to over $90. I mean, as we speak today, it's a little bit under that. But I think there's very little doubt that it's going higher. And I think JP Morgan are forecasting $150 price for oil. And more importantly, for those of us in Europe, anyway, what the Russians are doing is they're putting the squeeze on heating oil and diesel. Diesel is virtually the same as heating oil. It's just a sort of more refined version of the same thing. So those prices are rising. And in the last quarter or so, they've risen by over 40%. So that is going to start impacting on virtually everything, because 95% of logistics in Europe is diesel driven. So that's going to affect virtually everything. Some food prices are also rising, though others with a more seasonal bent, such as wheat, have actually been falling. But you can see the direction in which prices generally are going. There's a lot of pressure for higher prices, and they are realized as higher prices when our beloved central banks make the credit available in order to be able to do it, a credit card, whatever. So the result is that prices are rising, and this is going to make the winter extremely difficult. I think that it's not all plain sailing as far as the Russians are concerned in particular, because the history of the performance of the ruble has been that higher energy prices actually don't support the ruble. I mean, if anything, it's the reverse. If you create a crisis in fiat currency land, then people go to the dollar. And that's exactly what we're seeing at the moment. I mean, people are buying the dollar because everywhere else looks really pretty awful. So that's why they're doing it. Now, I think the big news, and this has really surprised everyone, it hasn't surprised me. It's just the velocity with which it's going, I think, has been a slight surprise, but it's telling us something. When you look at the 10-year US Treasury bond yield, it's the highest it's been since 2007. And looking at my screen, it's 4.72%. What's interesting is that last month, the Fed came out with really a dovish approach to interest rates. They turned around and said, well, we're not going to increase it this time. And as you would expect, they said, well, this inflation fight isn't over. We may have to increase it later on and later on. Now, what's surprising is that you would have thought that the yields on US Treasuries would have softened in the wake of that. But no, they soared. So what does that tell us? Well, I think the problem with it really is that it's indicating that there is a crisis in collateral. This is terribly important because virtually every financial deal involving derivatives and leverage and all the rest of it, you require to post collateral, and that collateral can be cash. Very often it can be bonds.
What do you think of Andrew's point? Do you agree with him? Post in the comments section down below your honest opinion, and also post your gold and silver prediction for end of 2024. Send this video to someone who hates gold, and I see you next time.